Yes.
Perfect. Well, thank you guys for joining us. We've got a fabulous expert on all things self-directed IRA, 401k, all the things to help you make the most of the investments that you have in retirement accounts and that you may not think you have access to, but actually you do. And so Amanda will be talking to us all about how we do that and make the most of those investments. Let me get here. Yeah. Okay. So I know you all know us. Suzanne and Sarah, we're the real estate duo investment experts in Central Oregon. Both experts ourselves in investing, but we still have a lot to learn. And 401, self-directed 401ks has been something on my list for a long time. We did have a speaker that did this, I think maybe 2 years ago. But Amanda, after I met Amanda on a mastermind call with the mastermind that I'm in, I was like, oh, wow, this is the one. She knows her stuff. She is
Uh,
totally like, this is what she lives and breathes every single day. And she breaks it down in a way that really makes it easily understandable and gives like clear guidelines on how to do what and how to maximize this, especially from a tax perspective too. So she's got lots of tricks up her sleeve, and yeah, we're just excited to have her here. So if you're not on our mailing list, we send out the Real Deal email every single week where we are scouring the Central Oregon market for the best real estate investment deals and writing our own candid commentary about them every single week. So if you scan the QR code, you will be put on our list and you'll get all of our fun thoughts and commentary every week. It's pretty fun. And yeah, so we'll just dive on into the agenda. So Amanda will be talking about how self-directed IRAs and solo 401ks work and how to use retirement funds to invest in real estate before you retire. So being able to basically access and invest that money in a different way than you might think. I think, for myself, having come from the corporate world and having all these rollover plans sitting in various places for a few years, it was just like, what do I do? Do I leave it in that account? Do I roll it into Vanguard or Charles Schwab or something like that? And, those are all options. But another option is to roll it into a self-directed IRA or a 401k that Amanda will talk to us about and be able to invest it in something else, something besides those target date funds or, mutual funds or whatever it might be that your former corporate employer offered you. You can actually invest in real estate, and that's where the term self-directed comes from. But I'm not going to steal Amanda's thunder. She knows all the stuff, but just to kind of, in layman's terms, explain like what this actually is. That's, being able to use those plans and tell it what to do yourself.
yeah.
You can also use these plans to be a private lender. And as a private lender myself, I'm super interested to hear more about this from Amanda. And so we'll be talking about what active investors are doing with some of their accounts right now, their self-directed accounts. And then Amanda will also talk about a few things that you cannot do with these self-directed accounts. So it's just important to know what you can and can't do, what the tax advantages are, and those types of things. And then also, of course, with anything uh, related to retirement plans. The IRS is, got their fingers in it. So you have to stay compliant, right? It's just like with 1031 exchange and other things.
Mhm.
Raise, same thing. You got to stay within the rules in order for these things to work for you and so that you're not inadvertently triggering a taxable event. So,
Well said.
um, and so we've got John, Jason, and Ankit, I think. John, we heard from you first, so you might want to just give us a little bit of background about you and what you're hoping to learn from today's event.
Yeah, sure. Can you hear me okay?
Yeah.
Hmm.
My name is John Tarantino, and I live here in Bend. Been here about 8 years, and I have most of my experience in real estate has been in property management, but I do invest. I have a couple properties, and looking to get more into investing and using my property management experience to just help me navigate through that successfully. And I don't have a 401k. My wife does not either because she has a corporate job, but she elected not to do that. But I do know many people who do have those. And so I just was hoping to get out of this meeting, just being more educated about that. So maybe I could help somebody else, find an avenue to invest that rather than let it sit there, as you guys were saying. So thanks
Sure.
for having me and always appreciate being here.
We love having
Thanks,
you.
John.
All right, Jason, are you available to unmute and tell us a little bit about yourself? We can come back to
Oh,
you if
we
we
can come back.
have the time. Uh, Ankit, am I saying that right?
Yes, you're right. I'm Ankit. I'm based out of Seattle. I'm new to this and just trying to learn, as the topic says. How can I take advantage of existing 401k to invest in property?
Perfect. Ankit, do you have, welcome first. Is it a current 401k that you have?
Yes, current 401k, and I have from my old employer as well.
Okay, perfect. I'll make sure I touch on those just for you. Okay.
Thank you.
You're welcome.
Perfect. All right, Jason, if you want to pop anything in the chat, if you're not able to talk, we totally understand. But if you could just tell us a little bit about what you'd like to get out of the meetup, where you're from, and if you have any 401k or IRAs out there that you might be able to put to use, that would be super helpful so we can tailor the conversation to you as well. So I'll do a quick intro for Amanda. Actually, Amanda, why don't you're the expert on you. Tell us
Yeah.
about yourself.
Yeah, I got it. Yeah. So, hey guys, awkward handshake over the Zoom completes. Yeah. So I've been a senior member of the specialized trust team almost since inception. I've been drinking the Kool-Aid of the self-directed IRA world for 15 plus years. I'm also not just a, self-directed specialist, that's going to spout, publication 4975, blah, 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 blah. Where I also invest, I lend, I'm a wife, a mother. Then guess what they do? They all invest as well. So everything I'm going to teach you here today, I just wanted to say, because I've been to more educational events and webinars and podcasts than I can count. I consider myself more of a guru versus a guru on the topic. So I just figured I would just say that as a disclaimer right up front. But yeah, I'll make sure that each of you here get what you want out of this. So you've got some golden nuggets. But yeah, and when you're ready to get started, Suzanne, we'll rock and roll.
Over to you. If you want to share your presentation, then
Sure. Okay. Hello. All right, I've got two screens here and I'm on the road, so I just want to make sure this comes across nice and clear for everybody. Okay, can you see my screen?
not yet.
Not yet. Okay. It should be showing.
I
It's
see it.
highlighted. Do you see it?
Yeah,
Oh, okay.
unlocking retirement
Oh, yeah,
capital.
yeah. Oh, I gotcha.
Perfect.
Okay.
Okay. Perfect, perfect, perfect. All right. Fantastic. I'm going to pull up the chat here so I have all of my ADD-ness satisfied. You guys know how that goes. We can see where we're at. This is what happens when you toggle all of the things. Okay, guys. So unlocking retirement capital, creative real estate deals in your self-directed IRA 401k. The disclaimer they make me do before I do any of these. Ready? Specialized trust companies, passive custodian, would recommend or endorse any system investment sponsored attorneys, not CPAs, nor tax advice. We are passive custodian. Okay, we're going to check that box. Yeah, we don't sell investments, guys. That's what that means. All right. So I just talked about, I don't like talking about myself. It's weird. I know some people are very like, oh, I can talk about myself all day. That is not myself. I've been doing this a long time. You can see, you may see familiar faces on there. I speak about this nationally. I do tons of podcasts and webinars, and I work with a lot of individuals, business owners, family offices, just to help you take these tools and implement them in your business for your clients, and just keep more money in your pocket, less than Uncle Sam's, right? Because I want you winning, right? Okay, so we're all, in the investment arena, we're all problem solvers. So I'll start with kind of the problems we all face together. So number one is like, know thy enemy, right? So the enemy that we first think of when we're talking retirement accounts, where are most retirement accounts? The stock market, right? What goes up must come down, right? So I always say, and it's, we've been in a bull market, the bears come in, and, it's just, you guys, this lack of control. No one has control over the stock market. In real estate, you have control, limited risk, it's tangibility. So the vehicles we're going to cover today, it's purely diversification, right? And the other big one, elephant in the room, inflation. Inflation's a big one. I mean, it's hurt all of our pockets. If you own properties, your tenants, it can affect rents. I mean, your discretionary income for many folks is gone. So it is more important than ever, not only just to watch your numbers on your deals, but also keep your money working for you where you're mitigating your risk. This next one, as far as like fees, I ask this question all the time and I get a plethora of answers. Like, what do you pay for your retirement account? That's exactly the answer I always get. I don't get one because nobody knows. Like, because when you look at your statements, and I don't mean to pick on any big guys, but pick a bank. Your Schwabs, your Fidelities, your Empowers, they don't tell you what your fees are, and that's the only vehicle that we're okay with that. And which I don't understand. That's like going and putting a property under contract and putting ish after it. Like, no, you know exactly your purchase price, your fixed costs. So with self-direction, I will just tell you what you pay for your retirement accounts. It's like between 6 to 7% when all is said and done. It is what makes Wall Street go round, but a self-directed account is a fraction of that, just so you know. You're looking around, between the 1 to 2% mark, just depending on the value of your account. Like a $300,000 IRA, literally everything included in fees is a 0.5%. So I always like to I always I don't do anything without knowing what your costs are, but you should be looking at every vehicle, including your retirement vehicles, in that fashion as well. And I'll talk about small business plans too, because there's some tax incentives out there, guys, that like like your 401k provider at W2 World, they're not telling you because it doesn't pertain, but there's definitely incentives out there. And then the one that sucks us all in the teeth is just freaking taxes. Taxes just suck, and they're everywhere, and they're going up. So if you can figure out how to keep more of what you're making instead of giving this guy all of your money, you're golden. That's what we all go through the whole anxiety and the stress of going up to the tax deadline. And if you're on the extension bus with me, I'm waving across the aisle there, like it's coming up here in the fall. So it's always better to be more proactive than reactive. So the whole point of today is not just how to make your money work for you. It's not how much you make, it's what you keep. And we've all heard that part, but I nod to Kiyosaki here because I like the second part of this. It's how hard it works for you and then how many generations you can keep it for. Because right now we're in the largest transfer of wealth that we're going to see in our lifetime. And add that in with AI and all of the other things that we can't control but are happening at a rapid pace. It's even more important to make a plan, because if you fail to plan, you plan to fail, right? And that's not what we're doing here today. So solution, we're going to be talking about our self-directed accounts. So what the heck are those? Okay, so your traditional retirement accounts. It's the same ones, guys. Traditional Roth, 401k, we'll go through all that. But when you have it at those big banks I was referring to, it's, hey, you get to pick that stock bond mutual fund yourself. And that's what they give you, an attaboy or an attagirl, and that's what they call self-direction. That is not true self-direction. They tell you that because that's what they offer on their menu. It's like walking into a Chick-fil-A and ordering a steak. I mean, I like Chick-fil-A, but you want a steak. You don't go to Chick-fil-A, right? They're not going to give it to you no matter how much you kick, pout, and scream. So if that's what you love, you want to invest in what you know. So when we're talking real estate, like even from the property management side, John, Can you do rental properties? Can you wholesale? Can you wholesale? Can you flip? All of those things in private lending we'll talk about too. Invest in what you know. That was the whole point. And this has been around since the 70s. Okay, so what I'm sharing is nothing brand new. All right, so here's your arsenal, right? Here are all of the types of accounts you can self-direct. So from the personal note, you have traditional Roth IRA, inherited IRAs. So someone you love has passed on and they name you the beneficiary. It then becomes inherited if it was not your spouse. Small business plans, your arsenal is the solo 401k. I call it the powerhouse. Here's my ninja moves there. Simples and SEPs. And then you have specialty accounts. So if you've got kiddos going to college, many of you have heard of like a 529. Those are state plans. A Coverdell educational account or ESA or CISA, they always have a million names, is the federal version. And then those of you that have a high deductible health plan, an HSA, you can self-direct. So think about that. That one's, I think, the most missed, Suzanne, because we're all going to have rising health costs. I mean, think of your body like an old car. Gotta throw money and keep it moving, right? If you can even think of like a rental property that's a tangible asset that's providing a consistent, predictable monthly return perpetually in a tax-free account that will pay for your health expenses, right? That's golden. Yeah. So again, I'm just planting seeds here. Okay, this is where I want you to take out a pen and paper. Okay, so this is where you do kind of inventory of yourself. We've all had past lives, to your point, Suzanne. Like you've had old corporate 401ks. Some of you may have worked for a county or been a police officer. You have a 457. You may have been into the military. You had a TSP or a thrift savings account. Profit sharing plans. All of these are just employer plans that if you're no longer there, Ankit, you can roll the old plans into any of those accounts below, whether it's traditional, solo 401k, etc. Roths go to Roth, and you can see here. This is a screenshotter. Now, for those of you listening that have a current 401k, write down this term. It's called an in-service rollover. Okay. When it's your current 401k, usually one of two qualifying events has to occur. Either you don't work in there anymore, which obviously we're not checking that box, or you're 59 and a half. So I didn't ask your age, but if you're not 59 and a half, then usually it's stuck there, but it's maybe. Some plans allow for an in-service rollover, and you have to use that term. And they will allow you to roll a percentage of your vested balance or your employee contributions, period. Okay. But yes, it's always just worth that phone call to double check. All right. So moving on. Self-direction is all about diversification. Okay. So what can we diversify into? And I know we're going to mainly focus on real estate here. So whether you're doing single family, multifamily, long-term, commercial, you do self-storage, mobile home parks, you can do notes, tax liens, private lending, gold, land, oil, gas, all of the above. Cattle, you can breed cattle in your retirement account. I have brothers in Texas that literally that's their business. Cows are pretty profitable. I didn't know this until I ask a lot of questions. You probably can tell. But yeah, it's a profitable business model. I never would have known that. I have family that are ranchers. I am not one. Yes, there's a lot of corn and cows in Ohio, but the point in sharing this is not to give you shiny object syndrome. It is to let you know that it is okay to diversify out of the stock market. We are not born stockbrokers. There's a reason this has been around since the 70s. So this is literally the ease of how you do this. And this is what I do, my team does. Okay, so you decide, hey, I want to diversify. And this is a conversation I'm just going to hit the nail on the head. The market has done fairly well. And I've had, I'm trying to time the market, Amanda. How do you think that's going to work out for you? It's impossible, you guys, but buy low, sell high, right? So when you are high, that is a perfect time to peel some off and diversify into something that's tangible, right? Real estate is what we're going to focus on, but that's one of the three basic needs of every human being. Okay, so hey, I'm gonna do it. How do you open an account? That's where I come in, my team. Literally, we'll have a phone conversation, figure out what makes sense. I'm going to send you everything done electronically already. All you do is click to sign, copy a statement ID. So you see those accounts on there, no matter how you're funding it, or even if you're funding with a contribution, you can do out-of-pocket contributions as well. So now we've deposited money in the account. That's done and done. Rollovers, just so you guys know, especially if you're looking at like working with clients or raising money, 2 weeks or less. Okay, so this isn't like oh my gosh, it's a 6-month drawn out process. Rolling over from one account to another, 2 weeks or less. Okay, and then direct it. You are the boss. You boss it around. Like I told you from the beginning, I'm not selling investments. I'm not pushing my agenda on you. You tell me what you want to do, and I will show you how to do it. And we're going to talk more of like how to do it, because in real estate, you can get super creative. Okay. So before I get to the fun stuff, the IRS does not write the rules and say, here are all the lovely things you can do to take advantage of our tax code. They tell you what you cannot do. So let me give you the bumper bowling so that we can get going. Okay, contributions out of pocket, sorry. Help with tax deductions? Yes, they do. So when you are contributing to a tax deferred account, so traditional IRA, tax deferred portion of a solo K, SEP simple, that will reduce your taxable income that year. Okay, so that's where I call it the team keep it accounts. So if you're running into the champagne problem of paying too much in taxes, those are the quote unquote buckets or different account types that you'd want to focus on. How to keep more money in your pocket and less than Uncle Sam's. Good question. Okay, sorry, I didn't mean to squirrel. Try to tackle them as we go. And if you guys have questions and you want to unmute yourself, please do not feel rude. You're not going to throw me off track. Okay, so compliance use. Number 1 is no personal use. Okay, so this is called self-dealing, if you've ever heard that term. So if you are looking to use a retirement account, guess when you have to benefit from a retirement account? In retirement. Okay, so you cannot benefit today. I get that a lot. So example, can I buy a house with my retirement account and live in it? No. What about an Airbnb? I'm only going to stay 2 weeks. Is anybody going to know? Yes, don't mess with the IRS, okay? If they say no personal use, no personal use, okay? No sweat equity, okay? Another version of self-dealing is if you buy a property and you don't have Carl the contractor and Paul the plumber doing the work, you're just going to go in there and wrench it out yourself. That's considered self-dealing. So you want to make sure you can be the boss. You can say who's doing what, where, and when. Like you are the project manager, like you are the boss of this account and what happens within it, but you're not doing it yourself. Okay. That's where, like John, property managers we love property managers because it keeps our rental owners that have properties in their IRAs at what we call an arm's length. Because your company is doing the work. You're collecting the rents and you're sending the rents into the retirement accounts. No commingling of funds. So when you have a rental property that is owned 100% in your IRA, can you just whip out your credit card if you need to replace the hot water tank? No, you cannot. It has to come from within the account. Think of the bubble. Everything's got to stay inside the bubble. That's what I mean by no commingling of funds. Avoiding prohibited transactions is really going into the next one of disqualified individuals. So prohibited transactions, you'll hear them called PTs, are just what you're not supposed to do. And majority of those are who you're not supposed to do them with. Yourself. You make sure you're not benefiting yourself. And there's a reason you're seeing a tree here. So it has to do with family members, right? So I know we've all done this like school assignment at some point in our lives. So when you have your family tree, you have you, your spouse, parents, grandparents, children, grandchildren. The trunk of the tree is off limits. Okay, so you can't go buy a rental property in your IRA next to your kid's college and let your kid live there. Or have your father be your private money lender out of his 401k for your next deal. Like those are no-nos. Now, if they branch off your family tree, brothers, sisters, aunts, uncles, cousins, nieces, nephews, people on this call, that's perfectly fine. You can find your what I call financial friends, right? You can lend to each other. That's perfectly fine. Okay. But those are the rules, guys. Like that is the bumper bowling. And when you forget all of this that I just said, because oh my gosh, Amanda talks so fast, I don't even catch it all. That's what our team's there for. When you have that, like, and 9 times out of 10, when you start using these, you get excited. And then you're like, crap, I don't remember my next step. Just call us. Like, I'm not a one-woman army. Like, I have a whole team in Albuquerque. That's where we're headquartered. I have an investment team that will walk you through step by step by step. Because just like everything else, like buying and selling in real estate, it's a checklist. We love SOPs around here. We live in compliance world. So hopefully I'm singing to some hearts by sharing that. It's not a big differentiator from what you're doing. Just think of these like separate operating accounts. Okay. That's how easy they are. Okay. So let's talk self-directed family. All right. So usually it's you and or your spouse, right? So before anything, before you're even a couple, you're people, right? You're individuals. So what are individual accounts? So traditional IRAs, which are tax deferred. So any money you put in there, you kick the tax can down the road. Roth IRAs and HSAs grow tax free, right? So I'm not going to, I don't like reading slides to people. I'm going to leave this up here as a screenshotter. And this is just more info than I care to verbally go over, but they're just the contribution limits. So you know how much you can put into these plans. Okay. But where you always start, if you're new to this, I will tell you a Roth IRA is where I will start everyone. Okay. And I'm going to touch more on a Roth because it is by far, even as a savings account, you should have money in a Roth. If you have kids, or yes, Roth, 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 Roth. And we're going to go into the whole tax-free thing here. Oh my gosh, it's next. I didn't realize that. Okay. So Roth. How does a Roth grow? I talked about kick the can down the road was tax deferred. So when you take the money out after 59 and a half, because if you weren't aware, that's when we all turn 21 all over again. That's when we can pull money out to say, go to the Bahamas and we don't get slapped on the wrist with a penalty. Okay. It's 59 and a half. But you pay tax on the whole freaking kit and caboodle. So let's think about that. If you're, 30 to 40% tax bracket, you got $1 million in an account, you might think, oh, my corporate 401k is $1 million. It's tax deferred. Is it really? How much is it? 600, 700K? Like, it's not going as far as you thought. So march in the Roth, okay, is the opposite. You pay the tax on the seed and not the crop. Okay. So you pay Uncle Sam his piece of the pie. Well, it's easy. So when it grows, grows, and grows, and when you take it out at 59 and a half or older, it grows tax free forever. Okay. And yes, it's super annoying, I know, but say it tax free. That is how a Roth grows. Okay. You will never forget it. All right. Why do I have everyone smiling and say tax free? Because who the heck wants to pay taxes? Nobody. That's why we do it tax free. Now, what do you need to have a Roth IRA? You need a heartbeat, earned income, and a social security number. Can kids have Roth IRAs? Abso-freaking-lutely. Just got to get them working hard for the money, right? Sorry, these are my kids, but there's a reason you see them in a recorded presentation as well as doing hard labor on our rentals, because I'm documenting that they're working for the business. Because are they earning money by doing this presentation even though they're not with me? Yes, they are. Because we're putting money in their Roths. We pay them, right? So when you're a business owner, you can pay your kids. It helps you out tax-wise. So it reduces your company tax return. Again, I'm not a CPA, but the max you can pay, it's just over 15K this year. So if you got a lot of kids, I was talking to a gentleman earlier today. He's like, yeah, I got 4 kids. I'm like, dude, it's like 60 grand. You can reduce your taxes by. Do you realize that? He was like, that's awesome. But here's the takeaway. And regardless of age, when you have money in a Roth, and this is how I explain to my kids too, the money you put in, you can take out at any time, tax-free, penalty-free. It is just the earnings that have to stay. So if you have money in a savings account, why wouldn't you have it in a Roth? What do you earn in a savings account? Diddly squat, right? So if you can earn tax-free profits and that grows and compounds for you, you're better off. Now, I love my children to death, but at some point in the near future, I want them out of my wallet. And I know they're going to be getting out of my house too. So two things is they can use it for tuition. They can use it for down payment on their first home, which if we're all fans of house hacking, Fannie Mae will end up to what? 4 doors? That's huge. Get them started on their own passive income, right? And that can be their seed money. The contributions, again, they can always take out. So maybe they wanted to start, their own trades business or whatever that might be. It's a nest egg for them to succeed as well as have tax-free growth in the future. If you do have kids and you're listening to this, a great exercise, and you can use ChatGPT to not have to do all the math. It works just as well, but it's a compounding interest calculator. Show them if they put 1 year of contributions in there and nothing ever again, how much they will have by the time they turn 59 and a half. I mean, I'll tell you, the account can do very poorly and they'll still be millionaires because they have so much time on their side. So that's huge. Okay, so now mom and dad got together. What happens when mom and dad get together? Who else usually jumps in that bed when you're entrepreneurial? Your business, right? Becomes like the third wheel of your marriage if you work with your spouse. Sorry, I love you, Jared. But here are your tools for business owners. So I'm going to explain it like this, okay? Because I work with so many and they grow from no W-2 employees to maybe one. Usually they start with like VAs and then 1099, then they go to W-2s and then they have more than W-2s. So this is the growth. Solo 401k, no W-2 employees. You and your spouse are okay. All right. That's the powerhouse account. Anybody that registers for this, I will send you like just a deep dive on this alone because we're going to be talking about it a lot. Once you have W-2 employees under 3 years, we pivot to a SEP. And then once you have W-2 employees over 3 years, we pivot to a simple. That's your growth trajectory. I don't know why this is not explained by financial professionals this easily, but that's your toolbox right there. I feel like folks get very inundated with that decision. I don't feel it's hard. And I mean, I know I do this day in and day out, but okay. So the powerhouse, because I think this is applicable to majority that will be watching this. So you have your company, all right? And your company, that is you right there in the center. Okay. But you're wearing all kinds of hats. But here we're going to focus on two. You're the employer and the employee. So going back to what we just talked about, as an employer, do we want more write-offs or more write-offs? More write-offs, right? So this is the tax deferred side. So you can put, it's not just an IRA, guys. This is 25% of your company's net up to $47,500. So if you're netting 100K, you pop 25K in there, you're only reporting 75 to Uncle Sam. So when you run into that champagne problem of sitting across from your CPA and they're telling you, oh, congratulations, you crushed it, pat on the back, here's your tax bill. It's like a sinking gut feeling. Now you can say, I have this plan. What are my numbers now? You can stroke that check to yourself in your 401k. For those of you listening that have old 401ks that are tax deferred, when you roll them over, they go right into this bucket, okay? So that's where they live. Just like if you went to a new employer and you took your old plan to move it to your new company's plan, it's essentially the same thing, but it's your company now. Okay. But Amanda, you were just talking about tax-free. Oh, this is where it gets sexy. So this is the tax-free side of the plan. Okay. As an employee, you can do 24/5 or 32/5 if you're over 50. So if you pay yourself that amount, you can literally take that exact dollar amount, put it in here over 3 times the Roth IRA limit, and it grows tax-free forever. So that in totality is 72 or 80,000. And if you're between the ages of 60 to 63, they even have something called a super catch-up. You can do a little bit more in that Roth portion. Crazy. But now I want you to screenshot this if you're watching. So this summary of benefits is why I talk this up so much. So yes, you have deeper buckets. You can put more in. You have tax diversification in one plan. Do you know how many tax environments we have in this country in retirement accounts? 2. You got both of them right here. This third one is an important one. So this is how you can make today money off your tomorrow money. The 401k is the only one we will allow you to do a restriction-free loan and then pay yourself back with interest over a 5-year period. Okay. So if you guys have talked, and I know from our conversation, Suzanne, you talked about like HELOCs and PLOCs and BLOCs, it's just arbitraging, right? You can do the same thing. Like when you're making that list of the cheapest capital to the most expensive, that 401k loan takes the cake because you're paying yourself back with interest. It all goes back to the 401k. And we're all fans of leveraging on here, right? Buying more assets with the same amount of capital, right? This is the only plan you can leverage without tripping a 37% tax. So if you're in rentals, you put a down payment and get a non-recourse loan, which I'm not a non-recourse lender, but we got resources we can share, for the remainder of the purchase price. And then you have a tenant paying it off inside of your account. Okay. You could do the same with a flip. You do the same with a burr. And when you do a flip, guys, remember the bubble I referenced? What's that nasty tax called when you flip a property? Sucks.
Capital gains.
Yeah. When you flip in a retirement account, no capital gains tax. No need for a 1031 exchange. Period.
Really?
Yeah. Because it's happening within the bubble. It's a tax exempt account.
Within a Roth Solo
So
401k?
401k. Yeah.
Okay.
Within any retirement account. When you flip,
Doesn't have to be Roth.
it doesn't have to be Roth. This one, if you're using leveraging, Suzanne, you want the 401k. So you don't trigger that UBIT tax. But even if you're doing burrs or if you have private money lenders that love you to pieces, I mean, you can put as little as like the earnest money down and have the rest of the acquisition and renovation all be borrowed funds. And then all of the profits go right back in, hopefully the Roth side, tax-free forever.
Wow.
That is huge. So that right there, guys. So if any of you are on this call and you're like, look, I'm closer to retirement than I want to admit on a public discussion, how the heck do I make up for lost time? Like you're just feeling like the pressure of time anxiety. This is the only vehicle that will allow you to not just 10x your money. I mean, you can over double in a year or less. I mean, look at what you can do in real estate and take those numbers and put it all tax-free. This is how you make up for lost time. And this is huge. I put this structure up there just because you hear it a lot, especially networking events. Oh, I have an IRA or Checkbook LLC. There's no such thing as a Checkbook LLC when you're talking retirement accounts. It is just when an account, no matter what type, owns an LLC. And an LLC have this fancy EIN, and you can get a checking account. That's where the Checkbook IRA or Checkbook 401k name comes from. But if you're doing active investments like flips or Airbnbs, this structure right here is like your best friend. But literally, how do you structure those deals outside your retirement account? In an LLC, right? So when you think of the practical application, you're literally just mirroring what you're doing outside the retirement account inside. That's as simple as it is. This next one, I wanted to put up the terms for the 401k loan in case anyone is on here that's like, hey, love this retirement account stuff, Amanda, but I need some cash flow today. Well, don't we all? Okay, so this is how you make the today money off of your tomorrow money. So many of you that have transitioned from W-2 world to entrepreneurial world, or you have old 401ks sitting there and you're trying to ramp up your passive income, maybe to replace your active income, this is the tool for you. You can literally roll funds over 2 weeks they're here, and then 3 to 5 business days, you can put 50K in your account. Now, the DOL limits you to 50K. So if you have 40 in your account, you can borrow 20. If you've got 500 in your account, you can still only borrow 50. Okay. And I wanted to make sure I note that. Yes, we'll actually send out a recording of this whole presentation for you at the end. Not a problem. I know I talk fast. I apologize. But let's get to the fun life rules. Size does matter. Did you guys know that? In retirement accounts. It's not Friday yet, is it? Nope. All right, so what I'm talking about here is a fun acronym we all know and love, OPM. And that stands for Other People's Money. So we like to say in our world, OPI, and it stands for, I won't make you guess, Other People's IRAs. Why? Because there's a boatload of money in them. There is over, and this actually number, I just looked at this. It's actually 49 trillion right now. I just looked this up for one of the last presentations that I did. I need to update this. This was actually at the end of last year. So it's growing, guys. It is growing. There is a boatload in retirement accounts, and those that you know in your sphere do not understand that they can take an old 401k and be the bank for your next deal. So let's talk about the technicality of like how that works, because I want to make sure everyone understands the mechanics of it. And then let's kind of, I don't want to say load your lips, but like how do you bring that up in conversation? Especially with maybe like an old coworker or a colleague or somebody at a networking event. You don't just run up to somebody and be like, "Hey, do you have a 401k? Any money in it? Do you want to be my bank?" I don't want you doing that. It's just sprinkling it into conversation. So here's how it works. Again, open fund account. When you're a private money lender, you are the bank. Okay. When you are the bank on a property, what does the bank do? You have a note you sign and a mortgage. That is your collateral, your security. Can it be a first or second lien position? Whatever two people agree upon are the terms. Okay. We, as the passive custodian, are not setting those terms for you. It's what two people agree to. So if you want to negotiate 10% and 2 points, or 8% and 2 points, or an origination fee, you can do all of that. Think of all of those fees when you get a mortgage from a bank, all of those fees they charge you. You get to do that now because your retirement account is the bank. And guess what that is to you? That's profit. That's exactly what that is. So the secret sauce here, guys, I'm doing a self-directed account on a mortgage or a note. It's the name of your account. That's literally it. So instead of Suzanne Moore, it's going to be Specialized Trust Company Custodian for benefit of Suzanne Moore's Roth IRA or 401k. Okay, that's simple. So now it closes at title. We've done verbal verification of wire. They record the asset. Okay. Now the person you're lending to sells the property or they refinance you off. Okay. So at the closing table, you're going to receive from the title company or attorney, depending on your state, the principal, any fees, points, and guess where they're going to send that? Right back to your retirement account. Tax sheet free if it's Roth. Okay. So that's how it works, guys. That's literally it. That is the cycle. So what I want you to ask before I get onto like the family is, and Suzanne, do you find a lot of people are raising private money or like they're just not quite sure how to have that broach that conversation?
Yes.
Okay. All right. So it's, and when you're talking with folks that are not in the real estate world, their reference is kind of like HGTV, right? Or they bought their own house. Like literally that's their, like they want to get into real estate, but they don't know how. So this is where they can earn while they learn and realize passive is better because you've got the active part down. Active real estate, that's the JOB, that's time, that's hours. But it's sprinkling it into the conversation. If you're a social media user and putting a post out there of how satisfied are you with your retirement account right now and put in your own words. Every person that responds, one, no one's going to respond, "Oh, I'm so over the moon." The people that respond are not happy. And when they're not happy, there's an opportunity for change. That is when you hop on a call with them and say, "Hey, did you know we're working with folks in their retirement accounts to fund our real estate projects? Would you like to hear more?" We could do a whole segment on this, but I'll give you kind of like the networking handshake one that works seamlessly. "What do you do, Suzanne?" "Oh, hey, Amanda, great to meet you." "Yeah, well, we earn double-digit returns in folks' retirement accounts by doing real estate right here in our backyard." Pretty cool stuff. Can I ask you, would you know anybody that's interested in that? What did I just do? You're like, what the heck are you talking about? You're going to ask more questions. One. Two, they're going to either going to look at you cross-eyed because they're not qualified. They're going to say, I'm interested, or they're going to point you to who is looking for it. That's the beauty of like the networking events. Um, but this is huge. Even in property management, John, asking those questions when you have folks that are bringing properties for you to manage. You know, do you hold properties in retirement accounts? Do you lend on properties? Just as kind of almost a survey so you know who your client base is. You have low-hanging fruit right there. I guarantee it. They already know you and love you. Um, that is a very easy one to help them grow. And you're bringing the education to them, so their loyalty to you will run even deeper. Okay, so you get married. What happens when you get married? Usually you pop out some kids. When you have those kids, what do we do with those kids? Well, I have to joke. We have a client. I love it. I always ask who has the most kids in the room. I won't do that today, but I call them the Niners because they have 9 kids. But yeah, you know, I don't even want to know what that math is. Was that like $135,000 they could write off if they paid their kids? You know, but my point is generational wealth, right? Like we talked a lot about our own retirement, you know, but how do we set up the next generation, but keep it freaking simple for us, right? I mean, look at that, the family with 9 kids. I mean, and think of your deal flow. I mean, you would literally, to make it even across the board, have to have 11 deals a year just to say, hey, I'm checking the box and I'm momming hard and I did the fairness across all of my children. I mean, I'll be honest, I've got 2 kids. One's with me. He's the second born. Does he have as much as my oldest? He does not. You know, and I do this for a living, you know, so I get it. I get it. You know, so what are some, and this is just like with everything in real estate, it can always be solved with deal structure, right? Every deal can be solved with creativity and deal structure. They always win the day. You know, so let's say this is your family. You know, you've got solo 401k, Roths for mom, dad, and kids. How, if you have 5 partners on a deal, what's a structure that you automatically go to? You can partner them together. You can have your titling be as long as the day, or you do a joint venture, right? Just whip up an LLC. Can retirement accounts partner together on LLCs? Yes, they can, because it's undivided interest. It's just like if you and a bunch of your family members own stock in the same company. It's the same concept, right? So let's say everyone across this board owned 20%, okay, of this LLC. So now you have one operating account, one checking account, and you're going to go do deals. You're going to have rentals, you're going to lend, you might flip. You could do all of it under one roof, okay, under one operating account. How are the profits split at the end of the day? 20% goes back to each one. So when they flow the profits back up to the accounts, boom. So this is much more advanced. Like I know Suzanne and I were chatting about, like, we do a family plan at our firm. And I'm not here to go through all like the education stuff that we do, but there's 2 big things here. You know, one, when you have IRAs, there's no tax breaks. Okay, they did away with that in 18. When you have small business plans, you do get a tax credit for your small business plan setup. You know, so your solo 401k under 50K, you're at like 2 grand. Okay. You'll get a tax credit, not deduction, a credit. So it's a wash when you file your taxes. This is just since 23. That is huge. The government is incentivizing you to save for your own retirement if you are a solopreneur or even a side hustle solopreneur. Ponder that. The next one is when you do additional accounts, right? I mean, everything has a cost to it, right? It adds up. And it's like, oh, I wanted to do all of this estate planning stuff, but it was starting to break the bank. Well, we made it so it's fixed and flat, unlimited accounts. And then we do the education, and we stress the education part to show you not only how to use this specifically for your strategy, but I'm not a CPA. What can you deduct under your business?
Education.
Education, yes. So again, I've stressed that because here at Specialized, we think outside of the box. for
So
you.
wait, can I just summarize what you just said? Because I didn't get it the first time I heard you. But what you just said is the fees that you pay a specialized trust company for managing your self-directed IRA get coded as education, which means they are a write-off, which I did not like, that did not compute. So like typically, with what I have at Vanguard or what Ankit may have at his, other rollover 401k company, like he's paying some fee that he probably doesn't know because none of us know what we're paying, but it's not tax deductible. But what you just said is because you guys code it as education, the whatever 3,500-ish a year gets to be a write-off.
Correct.
Okay. I just want to make sure that's clear because
Yeah. And again, I have to throw the CPA thing because I'm not one, but I work with tons of them. They look at our service agreement for education that just happens to include the accounts, and that's the whole point. Because again, guys, we don't sell investments. So the more successful you are with your accounts, the more deals you can do without breaking the bank, you're going to be happier, right? Because you're making some money, and happy clients stay clients, right? Oh my gosh, such common sense, right? And that's like not what Wall Street is. They're like, hey, you win, I win. You lose, I still win. Cool. Like, what other business transaction works that way? There isn't one. I mean, could you imagine getting married with those terms? No. Um, okay, I'm going to include more resources here for you. So this is even a deeper dive of like the deal structure stuff you can do within the account if you want to do this QR code right here. It's an on-demand webinar and you just register for it. It'll pop right up on your screen, but it goes more in depth with I'm a visual person. You guys have probably figured this out, but what does a rental look like? What does partnering look like? What does leveraging look like? More into the weeds there. And then I'm also going to give you guys, for those of my readers out there, I'm going to give you an ebook here in the chat because you guys stayed with me this whole time and I appreciate you for that. But yeah, I mean, as far as like our firm's concerned, guys, I mean, we're nationwide, we're passive. Our experience is not something you can teach. And that's what gives us the edge in the competitive edge in our market, in the self-directed arena. There's the DIYers, there's ones that charge you through the nose. I consider us, we're right there in the middle. We're the hand holder, the education, the consultant that we want to see you succeed. And it's not, hey, it's self-directed. They pat you on the back and say, it's in the name. Good luck, Chuck. You on your own. And that exists so much. That might sound really crass. And I know it can be a little bit of a smart aleck, but that's very true. Like that happens more often than you think. And what happens, because you're trying to pinch pennies, let's try that again. Pinch pennies when you're getting started, right? You're budget conscious. So someone will be like, oh yeah, $100 for this, I'll do it. And it's, that's like, paying using TurboTax when you're in real estate. Like you're ready for a CPA. Like don't, they're not expensive to begin with, and usually fixing stuff. That's what I mean. Like, just do it right from the get-go. It's like you don't build a house on a crappy foundation. Set the right butts in the right seats. I always joke and say like you're Avenger squad. And Suzanne, like you're a member of that Avenger squad. Like we're a member of the financial Avenger squad, right? It's not, you read the book, I'm sure, Who Not How. I mean, that's by far. I'm a big old nerd. I've done this a long time. And you know what I had to read even just start my knowledge? The revenue code. Who the heck wants to read that? It's very, yeah, that's a struggle bus for anybody. If anybody, they'll put Ambien out of business if they just had everybody read the revenue code. And we'd probably all be a lot richer. But yeah, I mean, who you see behind here, these are our family members, our team members. Like we do this, I know I talked about my kids. I don't mean to, but it's only fair because I don't want to pick on anybody else's children. But we practice what we preach. And I know some of you, I do talk fast, and this is a lot of like infotainment. So if you're holding your head in your hands, God bless you. I love you. I will help you and go over it very slowly. But I know I look like a talking business card because I'm always hopping on Zooms all day long. This is a direct link to my calendar. You can see it here. I'm more than happy to hop on a call. If you're not even sure where you're at on the journey, just it's have that conversation and make the connection. Happy to help anybody on here. So I will open it up to Q&A because I feel like I went a little bit long-winded. But if not, I really look forward to, I know we're in the summer and our attendance is always a struggle with webinars in the summer, but we will make this on demand. My QR code doesn't change. Calendars don't change. Yeah. So yeah, I'll zip it. Thank you.
Great presentation. So much information. Yeah. Ankit, Jason, John, questions?
No, I don't have any questions. Not right now, but this sounds, when you were talking about, taking out a loan and paying yourself back, that sounds a lot like the whole life insurance thing.
A little bit.
What do you think of that? I mean, that's kind of a whole other subject, but is that comparable?
Yeah, so a whole life policy is, so those are products that run very parallel to our world. And for those of you that don't know, when you max fund a whole life policy, you can borrow against the cash balance and you typically pay a percentage back, which doesn't go back to you, it does go to the company, but the key is like you can borrow against it, so you're not just banking on the death benefit, you can make some money from it today. But the key with whole life policies is you really have to max fund them to be able to borrow against the cash value. So either you need to have like a large lump sum to put in to be able to borrow, even a $50,000 amount, because it's not dollar for dollar. As far as borrowing. So great tool, love them for kids. Runs very parallel, but it does have a similar feature. Usually for most, the lower hanging fruit for borrowing against are because they have the old 401ks, they have the IRAs before they have like the whole life policy. But it does work very in tandem, I will say, with making today money off your tomorrow money.
Well, I've got to get going. Thank you so much, Amanda. This was really informative, and
thank you.
I thought you did a great job, and I love your sense of humor.
No. Thank you.
And thanks again.
That makes me feel good. So I'm not offending
you're very entertaining.
It's one version. Sorry.
Thanks, Suzanne, and we'll see you at the next one, I hope, if not sooner.
For sure. Yes. Thanks, John. We'll see you soon.
Okay, take care. Bye-bye.
I love it. Any other questions, Ankit or Jason?
Yeah, Amanda, thank you. It was a great presentation. I loved it. I have a question, like what do we need to open an account? Is it through an LLC or is it something that we need like a broker, not a broker, but an institution like Fidelity or Charles Schwab, something like that to do that? Because I know like they also offer these kind of services. So what's the difference actually?
So the difference is, and that's what I do here. So I do the self-directed version. So the 401ks, like, if you have an LLC, we would open a self-directed solo 401k here. Yeah. So I take the place of the Fidelities, the Vanguards. Okay. The differentiator is if you were to open that same account type at a Fidelity or a Vanguard, they're limiting you to just stocks, bonds, mutual funds, period. And at Fidelity, I'll just pick on them since you named it. They will say, oh, but you have a self-directed account. It's a self-directed brokerage account, meaning you can pick your stocks, bonds, mutual funds yourself off the screen, but you could not take them a purchase contract or do a rental property or a promissory note or invest in a private company that doesn't have a ticker symbol next to it. So that's the differentiator. Okay. So, and also, when you have a self-directed account, that doesn't mean that you couldn't have a brokerage account attached to it, as well as real estate, as well as lending, etc. So you get the best of both worlds when you have the self-directed version. Does that answer your question?
Yeah, that answers my question. And I have another question. So for the contributions to this, so usually like traditional 401k, it gets, you have pre-tax option. In this case, it's basically everything is coming out of pocket after the tax for W-2 incomes, right?
So you have the option. So
Okay.
just like when you have open enrollment at your current 401k and they say, okay, Ankit, would you like to have your employee contributions pre-tax or post-tax? Correct?
Hmm.
That you have the same control here, whether you want it pre-tax or post-tax. I talk a lot about the post-tax side for the employee because it's rough.
Yeah.
It will go way farther for you because
Yeah.
as the employer, you have the tax deferred side. Now, if you ever look at your 401k statement, which bucket did your employer put their match in? The tax deferred side. Why'd they
Mm.
do that? It's your benefits plan. Why'd they do that? They got a tax deduction for it.
Mm.
That's why. But it
I
was
see.
packaged up as your benefits plan, not theirs. But that they do get, they do get a little win back for doing that. And that's why it's always in the tax deferred side.
Yeah.
But yeah, I'm
And
happy to
these are
hop
not
on a
payroll
call and
deductions, right?
look.
I mean, this is something that is something I'm setting up, but usually like employers have fixed set of whatever broker or whatever bank they institution they work with, and that's the only option, right? So
Correct.
this is something, whatever comes after that from W-2 is something I can redirect from my own personal checking account.
Correct. Yeah, you can do contributions from your own personal checking, and your old employer's 401ks could go into any type of self-directed vehicle as well. So if you're looking like just getting into real estate, a great way to like dip your toe in the pool, is being like a private money lender, for example.
Mhm.
So you're lending on a deal so then you get to earn a return, yay, but then you get to participate in a deal from start to finish. So you can see all of the nuances throughout to see, okay, is this something I would want to do? Do I see myself flipping? Do I see myself renting, Airbnb? What category of real estate do you see yourself into? But yeah, it's diversification. That's exactly it. But what I was gonna say is if you ever want to hop on a call, is everyone always asks, well, what do I got to do beforehand? Like, what's my homework?
Yeah.
Just gather copies of your most recent statements and we'll take a look at what you got going on together. And that way you can basically highlight what you can do with what where. Because you're never obligated to do like a whole account. You can always do partial transfers. Like I said, you dip your toe in to see. And if you dip your toe in, guys, and I mean, I jokingly say this, like you the boss, you are the boss. Like if you're
Yeah.
like, this is not for me, like, and I'll say like for folks that are not comfortable making their own decisions, they're just a ball of anxiety coming up to making a decision where, it's like breaking out in hives. This is probably not the vehicle for them. Like,
Yeah. Yeah.
they may be, that S&P looks mighty comfy, but for those of you that, but most are in that bucket where they're like, okay, I know there's a better way. I just need to educate myself about, what tools there are and, see what makes sense. It's just like if you
Yeah.
bought a property outside of a retirement account. You tried it. If you don't want it, what do? You sell it.
Mhm.
No big deal.
Yeah. And one last question, sorry. So if we like there is associated fees with even opening with your firm, right? Self-directed. And
Mhm.
I that is, I think, something maybe in one call I'll get to know.
Yeah, absolutely. So when we do
Yeah.
that phone call, because it's always a one-time setup fee, an annual fee, and we do an all-inclusive transaction. Like that's big for our firm. That's like our competitive edge, right?
Okay.
So the annual fee is just based on the value, and I break it down 1, 2, 3, just like that. And if we do a small business plan, you get a tax credit for it. If we're talking an IRA, 225 setup, your annual fee is, just so you guys have hard numbers, and I hate going over numbers without having like a visual for you, but let's say under 15K, it's 247 bucks. If you
Mm.
were 200K, it's like 1225. So they're not expensive. So when I add
Okay.
on the all-inclusive transaction, you're at 1% or less. I'm sorry. Just choking here. I've been talking too much.
All good.
Let me not make my eyes start watering. Very ladylike of me. I apologize.
Yeah. But yeah, I gotta go too. But thank you, Amanda. It was great.
Absolutely.
I
Yeah,
might
let's hop on a call
be
and we'll
scheduling
dig into all that.
one-on-one. Yeah.
Okay, fantastic. Look forward to it.
Okay. Thanks.
Thank you so much. I'm excited to have this on our YouTube channel as well. I already had somebody reach out directly and say, "Oh, I missed it. I want to see the replay." So we'll get it posted. And yeah, just really appreciate your time. And I will be scheduling a call with you as well. So
Awesome.
yes,
Okay.
very excited. And yeah, looking forward to doing some of these creative things that you talked about for private money lending and all the other, yeah, tax-free flipping. Like I had no idea those were a thing. That's
Yeah.
amazing.
Oh, absolutely. Yeah. With what you're doing and you're like, I love passive. Yeah, I think it'd be good. All right. Well, thank you. Thank you for sharing this out with the world. Thank you for everybody that was able to attend and that watches the recording. And yeah, let's go make some, tax-free profits.
Oh, have a wonderful rest of your day and thank you again.
You too. Bye.
Bye.